what's up, everybody? It is Monday, October 11th. Monday, I sent out the new issue of MMT Trader. If you want a copy of that, go to my website, pitbulleconomics.com. So today was Columbus Day holiday here in the United States. Stock market was open, but the bond market was closed. Maybe that's a good thing. I don't know. But today was a classic day in the sense that we had a strong rally on the opening, and that dissolved and the market settled lower. Now, I said it was classic because this is the kind of trading action you're going to see in a market correction, particularly where the underlying economic conditions are getting weaker. And that's exactly what is happening. Fiscal flows now, and I think I might have mentioned this on Friday, down to a paltry 16.5 billion per day. That comes out to about 334 billion monthly. That is even, I mean, you have to go back over 2 years to see a flow rate, a fiscal flow rate that, that's low. That is low. Again, just to remind you, in March of 2021, March of this year, we were doing 984 billion a month. Then April, May, June, in the 700 billions per month. July and August, in the 600 billions per month. September dropped down to 576. September was the month when they ended those supplemental unemployment benefits. 576 billion, which is still respectable, but now we're down to around 334, 350 billion. That's below like the pre-pandemic level that we had, which was around 420 billion. And look, I said third quarter GDP is already, the estimates for that is 1.3%. I mean, that is a significant drop off from a 6.5% growth rate in the second quarter. And I'm even saying that we could see a fourth quarter negative. The economy might already be in a recession or entering into a recession. I mean, these are really, really slow fiscal flows. Now, maybe they're going to pick up. I don't know. We've been under the debt ceiling constraint, and last week, Congress finally voted on that, and we got the debt ceiling lifted until December 3rd. But we're going to be right back into that, contentious fighting in Congress, at the end of November. So all this is temporary. So I don't know. I mean, I'm pretty sure that we're going to see a sizable correction in the stock market. Starting this week, we're going to get the first reports of third quarter earnings. It usually starts out with the banks. I like the banks. I continue to like the banks. And I mean, banks are, as a matter of fact, as long as I'm talking about banks, I should mention that in the latest data, which was the week ending September 29th, we saw a very strong increase in loans. Now, that's not a coincidence because that was the week, actually the 2 weeks leading up to that September 29th period, saw a significant reduction in reserve balances. And again, here is it's a learning point that I'm about to make. Because I know a lot of you out there, you think, the Fed puts reserves, puts cash in, right? They're printing money, and then the banks lend that out. That's not how it works. As a matter of fact, as I've said so many times, this massive influx of reserves because of the Fed's asset purchases, because of normal Treasury spending, and it's been kind of, a new type of normal because it's been pandemic spending. So it's been mega trillions more than, what we used to think of as normal. I mean, this has led to a massive and historic increase in reserve balances, and it has been a constraint on bank lending. But in those 2 weeks leading up to September 29th, there was a pretty sizable drain in reserves. And what happened? We saw a big increase in bank loans. The problem is, last week, the reverse happened. We saw an increase in reserves again. So, I mean, look, the banks are sitting on like record levels of capital. And that's the only real constraint to a bank in as far as lending goes, is its capital. So, I mean, the banks financially, they're ready to lend. But we got to deal with this reserve situation. And secondly, if the economy is slowing down, then you have less qualified borrowers, right? I mean, borrowing is a function of your income and your debt. I mean, if your income goes down, then the income to debt ratio goes up, and then you may not qualify for bank credit. So that's a problem. But it all comes right back again to the fiscal situation. I've been telling you this every single time. I told you this on the way up, and I'm telling you this on the way down. You get a slowdown in the fiscal flows, and this is sizable, what I'm seeing right now. I mean, this is significant. You know, we're not talking about going from 984 billion to 600 billion. That was already sizable, all right? That's like a serious contraction, but 600 billion was still 50% more than the pre-pandemic. But now we're even below the pre-pandemic level. And stocks are really elevated. Risk assets are elevated. That's one of the reasons too why you see the weakness in gold. Like a lot of people are saying, oh, there's inflation. How come gold isn't shooting up? Gold is not an inflation hedge. Gold is a growth indicator. I mean, when the economy is expanding, there's more demand for gold. It's an industrial metal. People making more money. They maybe want to buy some more jewelry or whatever. That's when gold goes up. I mean, this whole thing about inflation and gold, that's just misplaced. That's a wrong understanding. Anyway, so we're in a corrective process. The rallies have to be sold until we see an improvement in these fiscal flows. Otherwise, the market will end up coming down, stabilizing at some level that reflects, you know, where we are right now fiscally. And again, I said that the market tends to overshoot. It overshoots on the upside and it overshoots on the downside. So we're in the down mode right now. All right, don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye.